Hey there, financial explorers, and welcome back to the channel where we demystify the market. Today, we're diving deep into a fascinating corner of the stock market, how to borrow stocks and the potential for a short squeeze. And we're putting a specific spotlight on a microcap name that's been popping up on our radar, PFSA Inc., ticker symbol PFSA. We're going to break down why PFSA caught our attention, what its current market dynamics look like, and what it could mean for its stock price. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo / stock chart. Let's zoom in on PFSA Inc. This is a digital health technology company operating in the healthcare and medical devices sector. They're developing bioengineered sensors like the Lumi oxygen platform designed to continuously transmit clinical-grade data from the body for medical use, particularly for monitoring compromised tissue. Show image of sensor / product mockup with a current market capitalization of just $3 million. PFSA is firmly in microcap territory. Looking at recent price action, it's been a wild ride. Today, PFSA saw a gain of plus 9.17%, but over the last 5 days, the stock is down a significant minus 63.15%. However, if we stretch that out to the last 30 days, PFSA is actually up an impressive plus 164.55%. Volume today for PFSA was 1,246,068 shares, which is only about 0.5 times its 30-day average volume of 2,420,115 shares. What's cost to borrow and why it matters. So, what exactly is hard to borrow and why should you care? At the heart of it is something called the cost to borrow, or CTB. When an investor wants to short a stock, they first have to borrow shares from someone who owns them. They then sell those borrowed shares, hoping to buy them back later at a lower price, return them to the lender, and pocket the difference. But borrowing isn't free. The CTB is an annualized fee that short sellers pay to borrow those shares. Think of it like interest on a loan. When a stock's cost to borrow shoots up, especially into the hundreds or even thousands of % annually, it signals intense demand to short that stock, or, crucially, a severely limited supply of shares available to borrow. This fee can eat into or even negate a short seller's profits, making their position increasingly expensive and risky to maintain. Why the stock is hard to borrow right now. Highlight CTB number on screen. Now, let's talk about PFSA. Our screen is flagged PFSA because its cost to borrow fee is currently an astounding 960.8% annualized. Imagine paying nearly 10 times the value of your short position just to hold it for a year. That's a massive burden for any short seller. This sky-high CTB suggests that available shares to borrow for PFSA are either incredibly scarce or the demand from short sellers establish new positions is extremely high. While we don't have current data on the exact number of shares available to borrow right now, PFSA's estimated float is a tiny 0.5 million shares. A small float means fewer shares are freely traded in the market, which can amplify price movements and make it even harder to find shares to borrow. Our internal composite squeeze score for PFSA currently sits at 50.6 out of 100, indicating a moderate but noteworthy combination of factors contributing to squeeze potential. Squeeze mechanics explained. So, what happens when a stock becomes hard to borrow with such a high CTB? This is where the concept of a short squeeze comes in. If PFSA's price starts to climb for any reason, perhaps positive news, increased buying volume, or even just general market momentum, the pressure on short sellers intensifies. They face mounting losses as the stock rises, and the steep 960.8% CTB continues to erode their capital. To cap their losses or simply stop the bleeding, short sellers are forced to cover their positions by buying back the shares they initially borrowed. This buying action, in turn, pushes the price even higher, creating a snowball effect as more short sellers are compelled to cover. This frantic buying by short sellers can create a rapid and explosive price surge that's a short squeeze. However, it's critical to remember that high CTB does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock price will ultimately fall, and they are willing to pay a premium to hold their short positions. Dilution risk check. When evaluating any microcap stock with squeeze potential, a crucial step is checking for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the stock price per share. Even if a short squeeze is in play, new share offerings can provide short sellers with an opportunity to cover their positions or create new short positions, thereby offsetting or even negating the squeeze thesis. For PFSA, we found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days, which is a positive sign for potential squeeze plays, as it indicates the company hasn't recently flooded the market with new shares. Recent reverse split watch. Now, something very important to note for PFSA, the company executed a 1-4-4 reverse stock split on August 17, 2026, which was just 8 days ago. Highlight data reverse split reduces the total number of outstanding shares and proportionately increases the share price. For example, if you owned 4 shares, you now own 1, but its price is theoretically 4 times higher. While reverse splits are often done to boost a stock's price to meet exchange minimums or make it more attractive, they also significantly reduce the float, making the remaining shares even scarcer. Historically, many microcap stocks tend to see renewed volatility, and sometimes even a price pop, within about a month after a reverse split. This isn't a guarantee, but it's a pattern we've observed in some names as the market digests the new share structure and resets expectations. Let's take a quick moment for another important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For PFSA, keeping an eye on a few key indicators will be crucial. Continue to monitor the cost to borrow fee. Any significant increase or decrease could signal shifting dynamics. If data on shares available to borrow becomes accessible, a shrinking supply would be a strong indicator of rising pressure. Watch for increasing volume, especially on upward price movements, as this could suggest buying interest beyond just short covering. And given the recent reverse split, observe how the stock behaves over the next few weeks, looking for that historical pattern of renewed volatility or a potential price pop. Remember, short sellers are betting against the company, and sometimes they have very valid reasons for their conviction. PFSA Inc. PFSA, with its extremely high 960.8% cost to borrow, small 0.5 million share float, and recent reverse split, certainly presents an interesting case study for understanding hard to borrow stocks and short squeeze mechanics. While the conditions are ripe for potential volatility, always remember that these are high-risk, high-reward situations. Do your own thorough due diligence, understand the company's fundamentals, and manage your risk appropriately. If you found this deep dive into PFSA helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other stocks you'd like us to cover. Thanks for watching, and we'll see you in the next video.